Hi friends, good afternoon. This is Shodadeep Dey on behalf of elandmarkets.com. I welcome you back to our latest edition of Weekly Market Learning Recap. Like last week, this week also we will discuss Nifty Futures and Option, Bank Nifty Futures and Option, MCX Gold and MCX Crude Oil from the perspective that whatever technical trades we could have taken this week. The sole purpose of this video is educational, and we are not going to give any futuristic price projection or behavior. We are not suggesting any trading or investment. So let us start. We will start with the Nifty daily chart. Here the Nifty daily chart is plotted in the investic.com charting facility. We have used the Bollinger Band and 34 period moving average. Here you can see the volume, and here you can see the stochastic and the 9 period RSI. If you don't know what Bollinger is or what stochastic it is, you can go to the blog section, that is blog.elandmarket.com of our website, and click on technical analysis and then click on indicators and oscillators. There you will find description of a lot of indicators. Here you can see that there is a blog on Bollinger Band, and similarly there is a blog on stochastic. So you can learn these two indicators and how to use them in your trading. Now let us go back to the Nifty daily chart. In the Nifty daily chart, you can see that the last week there had been a consolidation phase after this kind of an up move. The Dow's theory says that a trend which is continuing would continue until and unless there is a significant violation and price action. Now, as there was a consolidation phase and there was no visible price movement out of the range, you could have assumed that this week also the consolidation would continue. Now let us look at what we could have done. Let us go to the 1 hourly chart. From the last week itself, we could have seen that the market was trading in a very thin range, and it was giving trades at both end of the range. So this week on 12th, we could have gone long, and this kind of level has booked at the top end of the range. We could have again done this kind of entry and exit, so 5 to 6 times. So we could have got 250 to 300 points in Nifty, and that is very important to note that Nifty hardly moved from 100 and 120 points in this time. So that is the beauty of a range trading in a range bound market. In a trending market, if the market is moving in a direction, once we exit the trade, there will be no entry or very little opportunity to entry with a lower price. But in a trending market, a trader can assume very small stop losses and do multiple entry and exit to maximize his profit. Here we can see again in the last consolidation phase, the market provided multiple entry and exit. Now, as the market was consolidation, we could have also thought about going short in strategies like straddles and strangles. Here, once we go to the NSE option, any instrument, and choose the option chain and click on particular instrument, we would get like 9600 call here. Now we can click historical data and we can choose how many days of history we are looking. So similar way we can get data for a lot of calls and puts. Now let us look at 9600 call, 9600 put, 9700 call, 9700 put in specific, as the market range was very thin and consolidating. So considering the market will consolidate, if someone could have gone short in a 9600 strike straddle, that is both short 9600 call and put, you could have done it at price of 164 and could have booked it at today's closing price at 132, so 2400 profit. Again, similar way, 9700 call short and 9500 put short strangle would have given a profit of 2100. Those who have seen the last video would recognize that in similar market condition the profits were a little bit lower in last week. This is because as the days to expiry is coming down, the price erosion in options is higher, and that's why a short straddle or short strangle has given very good profit. Obviously, when you trade this kind of strategy, we keep a stop loss in mind. Like in this case, if someone has gone with a stop loss of 15 to 20 points in both the strategies, they could have earned this kind of a handsome profit. Now let us look at the Bank Nifty. Here we can see the Bank Nifty chart, right? The Bank Nifty chart, again we see the consolidation similar to Nifty, the daily chart. Now let us look at the hourly time frame. Last week what we were seeing, that from the 34 period hourly moving average or the 20 period moving average, market was moving to and fro multiple number of times and giving a profit of 150 points. Now the trend actually reversed and the market went below the 34 period moving average in hourly chart and the mid-Bollinger line also. Here also, if someone would have got short the first time they got a pullback, they could have got, because the range was very small, it was worth taking this trade. And 1, 2, 3, 4. So again entering long for from the edge of the trend, and again going short at the mid-Bollinger level. So this kind of trades someone could have taken 4 times, 3 to 4 times, so 500 to 720 points in Bank Nifty, that is 20,000 to 28,000 someone could have made in range trading in the Bank Nifty in last week. And that is very important because the Bank Nifty had hardly moved in a 250 to 300 point range during the whole of week. So this was the beauty of the range trading. Now look at the daily chart. We will find that the daily mid-Bollinger was around 23,260 odd level. So if the market was coming to this level, someone could have gone long here and booked at the upper point of the range. He could have gone straight to 220 points in the Bank Nifty, and that's quite good profit with a very small stop loss. Now, with the consolidation in mind, someone could have also gone short in a short strangle in the Bank Nifty. The short strangle here was, let us calculate it. The short strangle here was 176 rupees, and today at the day closing it is 85 rupees. So total 3640 someone could have made, and that is quite a goodish bit of profit with a very tight stop loss. So that is about the Nifty and Bank Nifty. Now we will discuss the MCX crude oil and MCX gold. Before going to MCX crude oil or MCX gold chart, we will again like to remind you that we track the chart of WTI crude oil for MCX crude oil charting and trading decisions, and we track COMEX gold chart for taking trading decisions for Indian MCX gold. The reason behind that, these commodities are traded almost 23 hours a day in global market, while MCX is open from 10 AM morning to 11:30 in the night. So almost 9 to 10 hours of trading we miss due to our market being closed. In between this time, if the global market moves in these commodities, we will find that there is a gap up or gap down in our market. Another thing that affects this Indian prices of gold and crude oil is that exchange rate of rupee dollar. But crude oil being a relatively more volatile product, the effect of exchange rate fluctuations is quite low in the crude oil chart. But if we look at gold, because it is a relatively stable product, there will be effect of substantial movement in rupee dollar exchange rate in Indian MCX gold price. So we have to track the rupee dollar exchange rate also for trading MCX gold. Now let us go to the WTI crude oil chart. Here the daily chart, and what we can see, the market was falling since last many days. This was an uptrend and then a downtrend started. Every time the price was actually going to the 8 DMA, the prices was having significant decline. Again, as Dow theory tells us that until and unless a trend is violated, a trend continues. So as we didn't get any signal that okay, this downtrend was actually being violated, so our assumption could have been easily that okay, we would be trading in the downward direction until and unless markets tells something otherwise. So let us see how the market behaved last week. We can see first 2 days till the day of Wednesday, the market was little bit uppish bias, but very small candles were there. And the moment it went to the 8-day moving average and also the inventory data came in, which was perceived bearish by market, the US inventory data, the price decline happened. Let us look at a 4-hourly chart. In the 4-hourly chart, we can see that again the prices came to the mid Bollinger level, and again it went to the 34 period moving average. Now what we had seen that in the initial part of the down move, market was being resisted at 21 DMA, that is our mid Bollinger line. But in the last up move, it actually went up to 34 period moving average and it came down to a lower level. Now again, when we look to take short positions, it was wise to not take it at mid Bollinger level, because we knew that as the last time the market went to 34 period moving average, it could be that this time also the market would reach 34 period moving average. And here you can see from 12 to 14, this was a goodish bit of consolidation, but the market never really closed above the 34 period 4-hourly moving average. And someone could have remained short here and he could have got a very good profit on this decisive move. This decisive move came within a span of 20 minutes. So if we look at last weeks of trading, we can be sure that this 20 minutes of the week were most defining, and someone following the rule that they would be remain short and could have got a good profit. See, here we can see that 34 period and 21 period Bollinger Band is acting as support for this period of the market, but it may not actually work that well in going future also. In past, sometimes it might not have worked. So every phase of the market is different. So a trader has to look at what is working in the near past and take some risks based on that and find some low risk entry. Now let us go to the Indian MCX crude oil chart. The Indian MCX crude oil chart is also similar. The difference is that the Indian market being closed 10 hours every day, so every bit of price movement in WTI is not reflected in MCX crude oil chart. Let us go again to a lower time frame, 4-hourly. Here we can see the market is falling from mid Bollinger of Indian crude oil price. But again, what I told that we won't be looking at this chart, because this chart, due to the time gap, the price being not traded those 8-10 hours, is not actually true reflection of chart. It is always wise to look at the chart of the WTI crude oil, and someone shorting here could have easily got almost 29.90 and this is 28.80, 110 rupees. And during the initial phase of the week, as we can see, there was a little bit of consolidation. So someone could have traded the MCX crude oil this way for the last week. Now let us go to the gold chart. Again, in gold chart, what we have seen that 8 DMA has worked as a support or resistance in the near past. I am again saying near past because sometime in the future we may see that okay, 13 may work or 5 may work. In the past also this has happened. So every market phase is different. So we don't know for sure that what is going to happen in future, but only thing for a trader can guess is that what has happened in the near past and can take trades based on that. But the factor is that market will change at point of time. Market changes. So a successful trader has to open his mind and always adapt to the changing market scenario and look what is working in the change market scenario. Now what we can see again is that it was a downtrend, right? So first 2 days the candle were very small, and then there was a small up move, and then let us go to the hourly chart, right? In the hourly chart what we can see is that again there were small candles. Market was actually taking resistance at mid Bollinger level and giving small down moves, and at this point of time the Bollinger band became very squeezed and the market actually moved above this 34 period hourly moving average and the mid Bollinger band. And then there were some Fed related news. Market went up very sharply and market came down. But see, if someone had noticed that okay, the prices have now moved above this 34 and 21 period moving average in hourly chart and could have gone long somewhere with a small stop loss, when the price retraced from here, could have goodish bit of profit. And when this kind of a down move came, I think many of the traders could have lost money in this kind of a very sharp move if they were not maintaining a strict stop loss. But once this move was over, again the price moved so sharply below the hourly moving average of 21 and 34 period. When the market came close to these levels, there was shorting opportunity and the market gave. And similarly we can see the MCX gold daily chart and MCX gold hourly chart. We will go, and a similar scenario was played out. This is for this week. Again I repeat that we are not predicting anything for the future. We are just guiding you that how you could have predicted the market last week. So thank you my friends, have a great weekend and look to meet you next week. I request you to give feedback in the feedback section below the YouTube video. Thank you very much.